Imagine this, you're a Toronto landlord and that condo you bought as an investment is now sitting empty for months, bleeding cash while rents have gone down by 9% in some spots. Sound familiar? Well, get ready. 2026 is shaping up to be the toughest year yet for rental profits. But there is the good news. Some smart landlords who adopt now can not only survive but thrive. In this video, I'll break down why rents are crashing, the hidden pain points killing your cash flow, and my top strategies to turn this mess into opportunity. If you're losing sleep over vacancies, continue watching this because this will save you thousands. Let's start with the cold hard facts. Right now we're seeing everywhere that rental markets has crashed and prices have gone down. In early 2026, Toronto's rental market is in a free fall. According to the latest CMHC rental market report and Rentals.ca data, vacancy rates for purpose-built apartments have jumped to 3.1% nationally, with Toronto hitting 3% for the first time since the pandemic. That's up from a tight 2.2% just last year. Average asking rents, well, they're down big time as well. In Toronto, they've dropped 4.6% year over year to about $2,500 for a typical unit, the lowest in 44 months. One bedrooms are seeing even steeper declines, down 6.5% in some segments. And it's not stopping. January marked the 16th straight month of annual declines across Canada. Why the drop? A massive wave of new condo completions. Over 32,000 condo units flooded the GTA market in 2025, with another 24,000 plus expected this year. That's a record supply hitting all at once. Urbanation reports unsold completed condos increasing to all-time highs, forcing landlords to slash prices just to fill the units. If you're seeing longer listing times or offering 1 month free, you're living this reality. So what's driving this rental apocalypse? It's not just bad luck, it's a perfect storm of supply flood, population slowdown, and economic headwinds. First, let's talk about the supply flood. Toronto's building boom from the low interest era is peaking now. CMHC notes record apartments completion in 2025, with investor-owned condos adding tens of thousands of rentals. Many of these are high-end units in downtown towers, creating an oversupply in the luxury segment where vacancies are hitting 10% or more. Developers are scrambling, but the pipeline for 2026 is still massive, over 20,000 units expected. In addition to the new condo supply, we know the resale market has been soft. A lot of people that wanted to sell their condo and take supply off the market now can't sell anymore, therefore adding more supply into the rental market. Second reason is population trends. Ontario's growth is stalling. StatCan and the Ontario Ministry of Finance project net migration dropping sharply due to federal immigration caps. From a peak of 500,000 plus net gains in 2022-2023, we're looking at under 200,000 by 2026-27. This is the sharpest decline we ever had in terms of population, and that's really clearing up the demand. Fewer international students and workers mean less demand for those downtown rentals. Toronto's population growth hit zero in parts of 2025, a far cry from the boom years. Zero, imagine that. Third reason is economic factors. High interest rates are squeezing everyone. The Bank of Canada's policy rate is still around 2.25% in Q1 2026, with forecasts showing gradual cuts to 2% by year end. But for landlords with variable mortgages, payments are up 30 to 50% since 2022. Add in the economic uncertainty, slower job growth, higher unemployment rate at 6.5%, and renters are hesitating or doubling up to save. Affordability is at crisis level. The rent-to-income ratio just dropped below 30% for the first time in years, which is good, better than before, but it's still brutal. Now let's talk about how this hits you where it hurts. As a landlord, you're facing longer vacancies, units sitting empty for 2 to 3 months instead of days. That's lost revenue adding up fast, especially with fixed costs like mortgages and condos fees eating into your margins. Yields are tanking. What was a 4 to 5% cap rate pre-2022 is now closer to 3% or less in oversupplied areas. If you bought at peak prices, you're likely cash flow negative, subsidizing tenants out of pocket. And tenants, they're taking advantage. With more options, they're negotiating harder, demanding concessions, shorter leases, or walking away. 20 to 30% vacancies in new building. Rents down $400 a month. It's a buyer's market for renters. And if you're not adapting, you're the one getting played. Okay, so we know the situation now, but there are always solutions for every problem. Let's get to the fixes. Here are 6 actionable strategies to protect your cash flow and stay profitable. Number 1, price realistically versus holding out too long. Don't cling to 2023 rents. Use tools like Rentals.ca's or Urbanation data to benchmark. Drop your asking price 5 to 10% upfront to fill the units faster. Holding out for months costs more in lost income than a slight cost. Pro tip, list 10% below market and negotiate up. Number 2, offer incentives without giving away too much. Skip 2 months free. That's a cash killer. Instead, try targeted perks like free parking for a year or a $500 moving credit. Tie them to a longer lease if possible, 18 to 24 months to lock in stability. Number 3, give incentives to real estate agents. If you're listing your condo on MLS, sometimes offering good commission to agents, help tenants agents bring the tenant to your unit. I see this happening a lot in new built condos with lots of competitions, and the ones that are offering good commission, they usually get filled right away. Number 4, target the right tenants faster. Broaden your net. Market to stable professionals via LinkedIn or corporate relocation firms, not just Facebook Marketplace. Screen aggressively for credit and references. Quality over quantity, reduce turnovers, and also use virtual tours to speed up showings. Number 5, renovations versus price cut decisions. Weight the ROI. A $5,000 kitchen refresh could justify $200 more rent per month. But in this market, focus on low-cost upgrades like paint and lighting. If your unit's dated, reno now while vacancies are high. But crunch numbers. A 10% price cut might fill in quicker without the hassle. Number 6, also I see people use it, is consider short-term or medium-term rentals. If long-term isn't working, pivot to Airbnb. You need to check bylaws, as by the way. In tourist heavy areas, short-term / medium-term can yield more, but factor in higher turnover. You need to also furnish the unit, but I see some really good results with medium-term, minimum 1 month rental. You can do 1 month to 6 months or 1 month to 9 months, whatever works for you. Number 7 is renegotiate mortgages or expenses to offset lower rents. Shop around, rates are easing, so refinance if possible. Cut costs, negotiate lower property management if you have one. Bulk buy insurance, try to reduce your insurance costs and aim to shave 10 to 15% off your expenses to buffer rent drops. Looking ahead, when will this stabilize? Analysts like CMHC and RBC forecast vacancies holding around 3 to 4% through 2026, with rents bottoming out mid-year before leveling off. By 2027, expect modest recovery, 2 to 4% rent growth as supply eases and completion drop to about 15,000 units. And population hopefully will pick up slightly. Also, economic rebounds with lower rate down to 2% by Q4 2027 could boost demand as well. Prepare by building reserve now. Aim for 6 to 12 months of expenses in cash. Diversify. If you're all in on condos, consider multifamily or out-of-town properties, and stay informed. Follow CMHC and other economists' reports for insight. The market will rebound, but only for those who adapt. There you have it, why rents are dropping and how you as a smart landlord can fight back. If this helped, hit the like button, subscribe for more Toronto real estate tips, and drop a comment. What's your biggest 2026 challenges? Thanks for watching. Let's turn this market around together.